Everybody, welcome. Also, welcome to those in TV land. We're streaming this also for the people who are taking the course online. We're privileged today to have some visitors from Goldman Sachs, which is one of the premier investment banks in the world. I was going to say in the United States, but anyways, the world. And we've got three speakers. First is Howard Karloff, and I'll rely on you to introduce the next folks. But among many of the interesting work that they're doing there, one is looking at spoofing, which I talked about a little bit last week. So he's going to tell a little bit more about what they're doing at Goldman Sachs. And anyways, it's a rare opportunity to hear, from the real world how they use these sorts of stuff that we cover in this class, and try to leave time for questions, well, to the extent that you can. But let me let Howard start, and after they're done speaking, I am going to cover a few things because this is the last session before the midterm next week. So I'll talk a little bit about that after Goldman Sachs finishes. So let me hand it over to Howard.
Thank you very much, Tucker. Thank you very much for the invitation to come. It's a pleasure to be up here. Now, let me tell you a little bit about who I am and who my colleagues are. So I'm in Goldman Sachs in New York, and the team called Surveillance Analytics. I'm actually here on a recruiting trip, but it conveniently happens to be the work my team does is very closely related to something Tucker was just teaching me about. So it's very convenient. You have 3 email addresses right there. If you want to contact us, you can take a picture or write down the email addresses, and this is how you can find us. Okay? And I'll tell you in the next slide about our backgrounds. And you'll see that all 3 of us have connections to Georgia Tech. So specifically, Maria, who's sitting over in the corner there, did her undergraduate ISYE degree 2 years ago. Robbie, who's sitting next to her, did an undergraduate degree in ECE and a master's degree in EE at Tech a while ago. And I used to be a professor of computer science here. So I've spent 7 years teaching computer science here at Tech. So it's a pleasure to be back and lecturing to a bigger class than I ever had when I was here. And that's not even counting all the people who were watching online. And by the way, I really like interactive talks. And otherwise, when I'm in the audience, I fall asleep. So I encourage you to ask questions. And if you don't ask questions, I'll be disappointed and things will go too fast. So really stop me and ask me questions. When I'm in an audience, I need questions because otherwise I fall asleep. Okay. Now, so the team I'm in is called Surveillance Analytics. We're looking for market manipulation, insider trading, illegal wire transfers, things like that. I want to talk specifically about spoofing, and don't worry, I'll tell you all about what spoofing is. You'll see it's a very simple concept. And I'm going to talk about not only the design of, not only the algorithm that we use to look for spoofing, but also the engineering behind it. And unfortunately for me, as an algorithms person, it's a little disappointing because the design of the algorithm is actually very simple. It's the engineering behind it that is so hard. It takes so much time. Again, please don't feel free to ask me questions. Okay. Now, why do we care? Well, we care partially because we don't want people breaking the law, but also because the fines are enormous. I don't know how much you guys read the news about financial companies, but you can see here that the Guardian said the banks paid out 166 billion pounds in fines. That's billion, right? Not million. BBC News says the banks pay 60% of their profits in fines. Deutsche Bank agreed to pay $2.5 billion to settle a LIBOR investigation. That's the London interbank rate. They were charged with rigging the index for interest rates. And SAC Capital, that's Stephen A. Cohen Capital, agreed to pay a $1.2 billion fine for insider trading. So that basically, the fines often begin with B. And Goldman doesn't want to be fined. And Goldman really does want to keep the market safe, and clean. And my job is to help do that. And there are lots of regulatory agencies that regulate Goldman. This is a short list of some of the agencies that regulate Goldman. Goldman is active around the world. Goldman is subject to regulation in all the companies, in all the countries in which it does business. The Securities and Futures Commission, the Hong Kong Monetary Authority, FINRA, you can read these all yourself. And Goldman is very highly regulated. And basically, Goldman really does want to do the right thing. I happen to be in the compliance department at Goldman, and we're really trying to make sure Goldman does the right thing. And I'm going to talk about one of our big projects there. Any questions so far? Yes?
Are these regulations different for different countries?
Oh, absolutely. The regulations are different.
Yeah.
The Europeans have one set of regulations. The US, Hong Kong, Singapore, they're all different. It makes it difficult. Other questions? Yes? I'm sorry, I can't hear you.
Because of different regulations, you guys like to drive it.
I can't, because of different regulations, what?
How do you like to drive it? How do you do it?
We said we have to do different things sometimes in different countries to follow the regulations. It's true. Okay. Now, there are a lot of technical challenges when you operate at the Goldman scale. So we get something like, there's different data sets in different formats. You have SQL data sets and flat files and proprietary formats, and you have to work with all of them, and that's challenging. We have something like 1 billion pieces of text per year we get. Okay, we have a graph of the social network we built. It's about 1 billion, order 1 billion entries. It's a very large scale. It's not quite Facebook scale, but it's on the order of Facebook. Hundreds of millions of trading events in a day. So we get records of all the trades, on the stock markets, the options markets, and the futures markets, and we have to process them. And you get issues where things can change in the past. You can imagine someone changes a trade that occurred a year ago. That's an issue. The regulator might come to you this year and say, why was this trade 2 years ago not flagged? But why did you not raise an alert on this trade 2 years ago? So you have to keep records of everything you did 2 years ago in the past. And often, we don't need results in real time, but we need the results close to real time. So I'd like to get, if there are trades that happen today, I'd like to get a report about suspicious trading tomorrow. So it's a large scale, and the engineering issues are really serious. It's a really big deal.
Howard, one question there. I know if I say we're going to NASDAQ and say, hey, I would like histories, trading histories, they're not going to provide me histories that identify the traders.
We don't get the traders either.
But do you have, say, more information for trades that originate in Goldman?
Oh, yeah. If it's a Goldman client, then we have everything. But if it's someone that traded outside of Goldman, then all we know is the same thing you would know. Okay, so we don't know the names of the traders. We know that someone bought IBM at 12:03 p.m. at a certain price. We don't know who did it.
I'll be curious. I mean, maybe you talk about it later, but I'll be curious if you are able to treat, Goldman clients differently than arbitrary outside.
We do. We have more information about Goldman clients. That's correct. So in other words, we're going to look for spoofing, but we're not looking for spoofing around the world. We're looking for spoofing in cases about which we have knowledge. Okay.
Could you provide that data set to us?
Yeah, very good topic. Yeah. And someone asked,
trying to weave it into the narrative.
Someone asked me once if we use Amazon Web Services. No, we don't. We're not revealing. The data doesn't go outside. Okay. We don't want to be the next Equifax. Okay. So we have the surveillance and architecture. So we have the different. We have an SQL files, SQL databases, and flat files, and proprietary data sets and proprietary formats, and the Hadoop distributed file system. How many of you have heard of MapReduce? So MapReduce is a big distributed computing platform originally developed by Google. There's an open source version of it called Hadoop, which we use. It's very popular. That's Hadoop distributed file system. We have take all the data sets, and we have different processing pipelines, we have bookkeeping layers, bookkeeping processes, and then we flatten all the data sets, and we put all that into some process that does the surveillance. It looks for some illegal trading, right? Illegal trading. And it generates alerts. If we get enough alerts, if we get serious enough alerts, we report them to the government. And as I said, there are lots of technical issues here. And this is where all the work is done, by the way. You know, the design of the surveillance, I'll cover in a minute, is actually pretty simple. All the work is done in this stuff here. You know, all the engineering is a real hassle. Because you have huge data sets and different data formats. You think that the data is coming from an Eastern time zone, but it's actually in UTC, and there's clock skew between different processors, and you think that the numbers are in dollars, but they actually turn out to be in British pounds, or maybe even British pence or euros. You know, there are all these different issues with formats that causes huge problems. Okay, so I'm going to talk now about spoofing. Now, here's a definition. Here's an example of spoofing, and it's a very simple concept. So spoofing is a form of market manipulation. So suppose you have shares of a stock you want to sell. You have 300 shares of XYZ Corporation that you want to sell. So if you don't sell them in the market, you'll get a certain price. But if you could inflate the price before you sold the stock, you would make more money and you'd be happier. Okay. So here's one way to inflate the price before you sell the stock. So you submit a lot of buy orders. You want to sell. So you submit a lot of buy orders to the market for the same stock at a lower price. Okay? By submitting a lot of buy orders, you create the illusion of buying pressure. It looks as though a lot of people want to buy the stock. When a lot of people want to buy the stock, the automated trading programs will step in and say, people want to buy the stock, the price is going to go up, I better buy the stock now. And that actually pushes up the price. So by submitting a lot of buy orders, even if they're not executed, you push up the price. So once the price gets high enough, you sell the stock and make an extra bonus profit. And as soon as you sell the stock and make your profit, you cancel all the buy orders that were sitting out there. Now, it's perfectly legal to submit orders and not have them transacted. You can certainly submit an order today. Okay, maybe you can't quite do that. You can submit an order to buy Google stock at $1 a share. Now, it won't get executed, but you can submit such an order. Maybe if you're lucky, it'll get executed, but I guess that would probably mean that the whole market would crash. But you can submit orders at different prices, and they'll just sit there until they get executed or wait until the end of the day. That's not illegal. Yes?
So it sounds a lot like pump and dump, but I guess pump and dump has been around before. So how does
pump and dump is also illegal? It's kind of like this. You're right.
I guess
pump and dump is just a way of inflating the price and then dumping your stocks at the top. It's the same concept.
Yeah, I guess spoofing, is it more, I guess, specific to like high frequency trading?
No, definitely not. It's definitely not high frequency. There's nothing high frequency. I mean, you'll see in a second. But is the concept clear? You want to sell stock at a high price. If you submit fake buy orders, you will push the price up. Once the price goes up, you sell the stock at a high price, and then you cancel the buy orders that you never intended to be transacted, to be completed anyway. Yes?
So spoofing itself isn't a high frequency strategy, but I guess we're relying on the fact that there are high frequency traders who see the number of buy orders increase and pull up stocks. And
Correct. You're exploiting the fact that there are machines or people who see the buy book and see the pressure, and therefore will bid up the price for you. Correct. Okay. Now, it's not illegal to submit an order that doesn't get executed. However, it is illegal to submit an order that you don't intend to execute. The Dodd-Frank bill actually made it illegal to submit transactions that you do not intend to complete. So of course the question is, what does intend mean? So if you submit the order and you hope the price of Google drops to $1, there's nothing wrong with that. You really will transact if the price drops to $1. But if you submit the order knowing it with the intent of driving up the price, and you didn't ever intend to complete the transaction, that's illegal. So here's the example I just showed you a minute ago in pictures. At this time, you submit a sell order for 300 shares at $217.05. That's a bona fide order or a real order. Then 100 milliseconds later, which 100 milliseconds, by the way, is an eternity in this world. Okay, 100 milliseconds is like 1,000 times more than you need. You submit buy orders totaling 1,000 shares at a low price. That pushes the price up. Once the price goes up high enough, you sell the shares up there. And then 1 millisecond later, you cancel the outstanding buy orders. Okay, that's spoofing. I gave this talk once at Columbia, and someone raised his hand and said, "This looks really easy." I said, "Yeah, I just showed you how to do it. It's not very hard." So why should you not do it? Well, here's a case example of why you should not do it. It's illegal. The vendor Sorrel was accused of spoofing and even contributing to the flash crash in May 2010. I actually wrote these slides a while ago. He was brought to the U.S. to face charges. At the time, they said the charges could put him in jail for 380 years. I looked up how long he was actually sentenced to jail, and I couldn't find it. So I don't know how long he was actually sentenced to jail. Probably not 380 years. And he allegedly made $40 million in illegal profit, trading out of his parents' home in London. So this is the reason why you should not spoof. Manipulating the market is illegal. Yes?
How many shares or how many orders would you have to make in order to actually manipulate the market?
It depends on what you mean. So you can manipulate the market a little bit. You can make a small profit on each share pretty easily. You won't make $1 million on one transaction. You'll make a small amount. So you have to do this repeatedly.
Is it possible for one person to do that and make profit?
Yes.
Or is it a bunch of people making a lot of orders and then manipulating?
Yes, you could do this. One person could do this, but each transaction probably doesn't make you a lot of money. You probably want to do this repeatedly. Okay. And by the way, there's an issue, as I told you, there's an issue of intent. If you go and say, it has to be proven that you intended these buy orders to be fake. You never intended to transact them. And that's hard to prove. The way you would prove it is to give a whole sequence of events. Like one spoofing instance would not be enough to convince the jury. But if you did this 1,000 times, then the jury would believe it. Is there another question?
Are there any costs associated with placing the buy order?
No, the orders are free. Cancellation is free. If cancellation costs something, you could cost a significant amount, you wouldn't be able to do this. Good question. Yes? Sorry, what?
What if the buy orders are executed?
Ah, good question. So the answer, when the buy orders are executed, you bought, right? Then you bought the stock, and you're screwed. And that's exactly why you want to cancel quickly, right? You cancel 1 millisecond after you transact on the sell side because you don't want these to be completed. Okay, so you submit. The point is you have to submit these orders far enough away from the order block so they won't get executed. Okay, but the price, the prices will change over time. And if you don't cancel them quickly, they could get executed, and then you're screwed. And that's why it's important to cancel them quickly. Does that make sense?
If you were to conduct this enterprise.
Yeah. Right. Another question in the back?
So while trading, we have an account which is associated with where what we do. So when we, in order to do this kind of manipulations, we need to set at least, say, over here it is mentioned that more than 1,000 shares we need to buy. Now, isn't it necessary that our account should have at least that much amount of money to be able to afford to buy?
No, this settlement is actually done 3 days later anyway. So normally you wouldn't have to pay for a few days. So the money doesn't have to be in your account at the time. You're legally obligated to pay, but the money doesn't have to be sitting in your account at the time. I only have a few more minutes, by the way. So let me take one question right now.
Yes. So when you artificially created a fake demand,
Yes.
shouldn't the price be increasing on the top right from 270?
Well, I didn't show you what the price is, but the price will go up when you submit the buy impression. When you submit these buy orders, that'll cause buy pressure. That will cause the price to rise. When the price rises high enough, you can sell it at your desired price. But now, who knows what will happen to the price afterward? The price might drop, but you might have to buy these shares down here, and that's why you want to cancel quickly. So let me show you what we did. Okay? So we looked at regulatory cases. We looked at people who were actually prosecuted for spoofing, and we looked at what they did. And there was a high order imbalance. Order imbalance refers to how much more there are orders on one side than the other. So in the case I showed you, there were many more shares that you had on the buy side than you had on the sell side. In order to really push up the price, if you want to sell 300 shares, you have to submit orders to buy a lot more than 300 shares. Because there has to be an imbalance. There has to be more pressure on the buy side than the sell side. So you need to buy something like 1,000 shares if you're trying to sell 300. That's an order imbalance. And we said in these cases here, the imbalance is at least a factor of 2.5 in all these regulatory cases. And the time to cancel after execution in these 4 cases was less than 1 second. So in these 5 cases, you saw that there were 2 features that seemed to play a role. The order imbalance, that is the excess of buys over sells, and the time to cancel after execution. So that's basically what we did. We built a model looking for high order imbalance and very high cancellation speed. That is very quick cancellation after the transaction. So there are two, again, let me just say that again because that's very important. The two primary features are order imbalance, it's an excess of orders on one side over the other, and high cancellation speed. So cancellation very quickly after the transaction, the bona fide transaction is executed. Yes, Tom?
I assume it's order imbalance for one trader.
Just that trader, that's right. The particular trader has orders outstanding on 50 on one side and 1,000 on the other side. That's a high order imbalance. When I say side, I'm talking about buy and sell. So, 50 sell, 1,000, 50 shares to sell, 1,000 shares to buy. That's a high order imbalance. Yes.
I don't know whether it's just enforced by brokerages, but I know that at least retail brokers won't let you have conflicting orders like that at the same time.
Oh, you're allowed to do that. I don't know what. I mean, you're certainly allowed to submit orders at any prices you want, and market makers do this all the time in particular. There's nothing illegal about that. Okay. The two other issues we actually also include the profit and loss. How much money did the trader make by doing this? And marketability. Were these spoof orders reasonable orders or not? Were they close to the actual price or were they far away? If they were far from the actual price, then they weren't very effective. They weren't real spoof. They weren't effective as spoof. Okay. So I think I'm basically out of time. I'll skip the stuff on transaction pipeline. Here's just some issues we have. I mean, one of the issues we have, which I won't go into detail for lack of time, is that in order to do all of this, we need data which is at very precise times, certainly at the millisecond level. Okay, I can't tell you how quickly you cancel if you're not getting accurate data. So one of the problems we have is that some exchanges don't actually give you data accurate to the millisecond. They'll tell you that a transaction occurred at 12:03 and 56 seconds, not 12:03, 56.698 seconds, and we need the milliseconds. So that's an issue, and we have some workaround to deal with that, but that's one of the issues we have to deal with. There are also issues of lit versus dark pools. There are dark pools in the market where you can make a transaction, but other people can't see what you're doing. A lit market is the opposite, where you can make a transaction, but other people can see what you're doing. That's illuminated versus dark. Okay. And there's also this concept of an inverted market. The ask price should always be above the bid price. The ask is the price you're willing to sell at, and the bid price is the price you're willing to buy at. The ask should always be above. The minimum ask should always be above the maximum bid. Sometimes that gets reversed. It's strange. It shouldn't happen. So there are all kinds of technical issues. You can't assume things will work out the way you want them to. And if you now the important stuff. We encourage you to apply for an internship or a permanent job at Goldman Sachs, not at Georgia Tech. I used to be here, remember? And that's our website. We're going to be out in the hallway at the end of class. Come talk to us after the end of class. And now Maria and Ravi will talk also.
Thanks, Aaron. I did want to emphasize that, yes, after class they'll be available out in the hallway back there. So mob them.
All right. I don't have slides. Well, I guess we can leave this one. Oh, you want to say? So, hey everyone, my name is Maria Samuel. A little bit different background. I graduated 2 years ago, so fresh out of college, I came to Goldman Sachs, and I was pretty surprised to find what the company was like. So I'm going to take a few minutes to talk through that with you. I definitely came in thinking that Goldman Sachs was made up of bankers, traders, quants, and maybe a little bit of back office IT. I was pretty surprised to find how prominent the engineering division was and what they actually did. So I'll talk a little bit about that. Prior to coming to Goldman, I was an investment banker and a quant at JP Morgan. I came to Goldman Sachs and joined the engineering division as a product manager. Do you guys know what product managers are? Okay, cool. So in software engineering, the product manager is usually like the mini CEO of whatever tech product you're creating. So whether that's a trading platform, an analytics platform, a portfolio hedging tool, an investment banking deal insight tool, it's the person who decides what to prioritize, what to build, what not to build, and what actually matters to a business. And so the tech space of Goldman Sachs is pretty interesting because we've gone through a bit of a shift where all of the business and flow was typically created and managed by a lot of the business folks, the finance majors, a lot of people who have incredible business backgrounds. And today we see a lot more of a partnership between engineering and business to where whenever you want to execute a trade or be like opening up a deal or running an IPO, you've got people in hoodies and people in suits at the same table making these decisions. So an example is a few months ago, Snapchat IPO happened. Goldman, we placed them on the market, and so it was pretty cool to be sitting around the table with Evan Spiegel. Miranda Kerr was there, and I was just sitting there like, am I allowed to Snapchat this moment? So it was pretty cool. And so as an analyst, you get to really dive into a lot of different areas. My first team, I was a product manager in a very, very back-end tech system. It was like an underlying workflow system. So it was very far removed from the business. And I realized that that wasn't really my style. I wanted to see a lot more of the front-end business. So I moved completely to the other end, to a business management role, into a franchise manager type of thing, where I was managing a $42 million investment of tech investments. So that was pretty cool because I got to say, hey, let's invest in machine learning. Let's decrease our investments in these web platforms that we have right now and increase in our business intelligence and other analytics tools. So that was a lot of fun. But after about a quarter of doing that, I was like, I'm pretty bored again. And so I was like, okay, Goldman, do you have something else for me? So they threw me into this new team, which is called Marquee. And it was a pretty cool spot because in Goldman, we have different bubbles of people working. And one bubble can't necessarily see what another group does because there's a Chinese wall between them, and knowing information across the wall could actually be a regulatory problem because you're trying to operate on a public side and another group is operating on a private side. So being more on the private side at the time, I wasn't allowed to be able to transmit the information I was working on to groups outside of that. Now I work on the public side, so it's a little bit different because the group that I'm a part of, I don't know if you've heard of Google X. It's kind of like the incubator, the cool underground stuff that Google works on. My group is nicknamed often the GSX group. It's a bubble of us who sit in this kind of glass bubble. We have bean bags, wearing hoodies, wearing sneakers every day, and everyone around us is wearing suits, wondering what's going on in our bubble. So it's a lot of fun. But what we do is we build out a lot of the automated solutions and business solutions that kind of automate away a lot of what people do manually today. So 5-10 years ago, we had trading floors of 400, close to 200, 300 people. And today, that trading desk is 4 people large. There are 4 math majors, 2 from MIT and 2 from Georgia Tech. And so it's really crazy to see how the business is shifting today. And what I work on personally is I'm now the product manager of the Marquee platform. So we've got 80,000 investment advisors who use our platform to hedge their risk, to be able to build out their portfolios, to trade in real time, to be able to trade on the top prices available in the market, and to be able to manage their risk in a more educated way. A lot of what happened in 2008 was due to a lot of price, or I guess of a lack of price transparency and a lot of in awareness about how much risk your portfolios contain, whether you're overexposed to certain types of risk. And so what our platform does, it says, hey, hedge funds, hey, investment advisors, this is how much your factor risk associated with tech investments account for in the risk of your portfolio. So that's been a lot of fun so far. As an analyst, you get a lot of really cool opportunities. The building is pretty nice, but in addition to that, you get a lot of cool perks if you go out of your way to take on new initiatives. So I think one of the things that I've been lucky to do is Georgia Tech really taught me that at the end of a talk, you go and talk to that person and say thank you and ask them a question and you be proactive. And it's interesting because I go to Goldman, and in the first month of being there, we had this speaker series, and at the end, I just did what I normally did at Georgia Tech, and I went up and I said thank you, and I had a question, and no one else did the same thing. Everyone else just kind of shuffled back to their desk to do their day job. And I wound up making a really cool connection to this guy who's on the board of directors. Turns out he was a former CEO of Medtronic, Bill George. He's a Georgia Tech professor as well as a Harvard professor now as well. And he's been able to introduce me to a lot of people. So now, as an analyst, you get to, like, if you take initiative, you can be like building side projects for the CFO and CIO and working with cool, like, tech CEOs on their newest deals. So it's been really cool so far. The engineering efforts are pretty awesome. A lot of times, very cool tech initiatives stem from little side projects that you do after hours. One that was kind of like machine learning based is we have an internal chat system called Symphony that we actually sold off because other buyers were interested. But it was a group of engineers who were a bunch of my friends who were just building this thing on their own, and they created chatbots that could help answer your questions. So think of like Stack Overflow, but when you're in a large company that deals with a lot of regulated information, you can't just be posting out to the world your problems because it could reveal what your business is trying to do. So an internal Stack Overflow that is a little bit more machine learning based in order to help you find out your answer to your question. So some cool stuff like that, as well as trading solutions and systematic trading strategies. So that's a little bit about what I've worked on, kind of the opportunities that I've been able to have. It's been a lot of fun so far. I get to travel down to Georgia Tech and see you guys. So do you guys have any questions about what it's like to be an analyst, what it's like to apply?
There's a question over there.
Oh yeah, what's up?
We're in the tech division the whole time. Like, how do you liaison with the guys in the operations?
Yeah, so great question. The firm operates in a lot of different segments. We've got the tech division, which is about 10,000 of the 30,000 people at the firm. We also have a huge operations division, securities division, and that's financial securities products, not like building security. And then there's finance, there's investment banking, there's global investment research. All of these groups have to work hand in hand, as well as with compliance and legal and more like control function groups to be able to make any sort of decision. And so when I'm building out a trading platform, I have to be working with our ops team who's going to tell us how Treasury Ops is going to react to our new processes. I have to work with legal to figure out if I'm accidentally overlooking any laws. I have to work with compliance to make sure that we're completely compliant with every piece of regulation that we have. I also have to work with our salespeople, our bankers, to be able to say, this is actually what we're trying to do, and making sure we optimize for the business. So yeah, great question. And how I personally navigated the firm, I think my time has been pretty different from most because I started out in banking, moved to more of a quant role, came to Goldman, started in engineering and tech. I'm being asked to move to securities right now, so there's a lot of flexibility. So if you're ever curious or interested, they definitely like you a lot.
You think people with certain kind of work experience that you talk about what's
Sure, yeah. So right now we're looking for interns for this coming summer, so summer 2018. Additionally, we're also looking for full-time folks. So at the moment, a large part of our on-campus recruiting efforts aren't really like looking for certain types or certain years of prior experience. I think the most important thing for us is having a solid skill set in either math, computer science, some sort of engineering, having a curiosity in the space, and being a very good problem solver. So a lot of my team, they come from all different backgrounds. They're entrepreneurs, they're former Googlers, they're NSAers, they're all from everywhere. I personally came from like NASA and a much more like technical background, and I was unsure of whether banking and like coming to an investment bank was going to be the right thing to do, but it's been really interesting.
You probably need to get the next
Right.
Goldman person.
Next up we have Ryan.
Thank you.
Thanks for having me. I was a graduate student and an undergrad in Georgia Tech 10 years ago. I used to be a team where Tucker was back then. So I'm excited to be here. I'll talk to you guys a little bit about how the overall trading business at Goldman is it fits in. So Goldman, in the overall grand scale, there is investment banking, there is securities trading, and there is asset management. And within securities trading is where all the trading happens. So within that space, we are divided into fixed income products, there's equities products, and there is and within fixed income there is a breakdown of commodities, interest rate products, and currencies. So in all these things, there's a lot of opportunity to do machine learning. There's a lot of opportunity to come up with trading strategies. So the type of people that work here, typically in trading in this day and age, most of the trading is very, very data driven. You're not going to just be able to look at prices through your eye and try to figure out how to trade. So there are a group of people that are calculating risks, calculating on a real time, building trading models on a real time basis of taking the data and determine when to trade and what to trade. So that's one group of people. Then there's another group of people who help these folks to bring in and deal with that data, because you in market data, for example, in equity space, there's about 10 billion records that get created globally. This is not just Goldman. All the market participants, they create about 10 billion records daily. So you have to be able to consume all the data, run your algorithms, and like determine when to trade. That's a huge engineering effort, and it all has to happen really fast as well. So there are good people that build that are essentially doing engineering for all. And then we have I guess the people who kind of support all these platforms in a way. What I'm trying to say is, what type of databases are relevant for dealing with this type of data? Can you do regular SQL, MySQL type databases? You really can't, because MySQL is never going to be able to scale to billions of records. So you have to come up with databases, network architectures, caching methods, GPUs. That's the more recent trend where people are trying to build custom processors to actually crunch all these numbers. So there's a lot of wide opportunity for folks who are interested in trading to be fitting into the overall Goldman umbrella. So, and I think most of the folks that we have they either have a very strong mathematics background, or they have a very strong some type of computer science engineering background. You have to be very good problem solvers and be ready to dig into any problem. Any questions so far?
Which specific job titles are you looking to hire for, or tasks that they would do?
Yes, so most of the folks, we are first primarily looking for interns for next year, but also I think full-time folks next year is also an option. I think most of the folks who join, I think they go through like a training exercise or a training period for 1 year or so, and then probably in the second year they'll probably start making like real impact on business. Does that make sense? All right, so and one more thing I was going to mention. So overall, securities business overall, if you think about it, like a few years ago, it was all like not a few, let's say 20 years ago, it was all these trading floors which people used for screening and making decisions based on what they see. That's completely changed. So back then, we used to hire one type of people. They were also very, very smart. Now you just hire like very, very data-driven and very, very smart people. So one thing about Goldman is, the reason I've stayed there for 10 years is I've always had the opportunity to work with very, very smart people. I mean, when I went from Georgia Tech to that place, I was like, hey, I'm a electrical and computer engineer. How am I going to fit in that place? The thing is, the people you work with are super smart, and especially today, last few years, there's a huge shift for all the trading to be heavily data-driven. So computer science and engineering is very heavily valued in trading at this point. So,
sorry, I should have asked Maria a question too. Sorry about that. But this is actually for you too. Come on up. Here's my question. Not for you, Carl, Howard. Okay, come on up. So here's my question. 5-10 years ago, when I was looking to place students into big investment banks. Actually, I've had some students there. I got word back that, look, the way to make it up the ladder is you've got to be a trader or portfolio manager. You know, the computer scientists are like, you know, I was going to use the word slaves to the others. Is that changing?
Okay, so that's such a valid question because.
Come, we can't see you on the camera. Come this way.
Okay. That's such a great question because when I came in, there was definitely at JP Morgan, there was definitely this mentality around your business, you're making money, or your back office, and like I don't know what you do, but I call you when there's a problem. And that's JP Morgan is a fantastic firm, but like
I guess we can
in a culture.
We can observe that you're now at a different place. Okay, all right.
Yeah.
Do you think it's changing overall?
I think it's definitely changing across the industry. And the reason for that is if you trade on gut instinct, maybe you'll be successful, but a lot of success today comes from your quantitative ability to make a decision. Whether you're an investment banker saying, you know what, I think the valuation of this company is X, and here's why. You're going to be much better at making that determination and making the right determination if you have a quantitative background instead of just a business gut instinct. And I was surprised to find this. But like I looked at like Goldman Sachs history of like who had been the CFO and CIO and like CEOs in the past, and I had done that same research across a bunch of different firms because I was trying to make a point to one of my friends. I'd made a bet, and I was like, you know what, this is really different because like you look right here, like in the 2010 to 2020 time period, and you're seeing a very odd shift in like who gets promoted to be the partners of the firm, who gets promoted to be the CIO, and also the CFO. Marty Chavez, who is a self-proclaimed like total math nerd, CS and math nerd. He went to Stanford for his, I believe, PhD, dropped out, started his own company, and then came to Goldman. Left Goldman and then came back, and he's now the CFO. And this is the first time a non-finance person, a non-business person, has been leading the firm on initiatives, and like the pendulum is really starting to shift, where like the orders are coming from the nerds, and and I find it funny, but also really cool.
That's great to hear that it's shifting.
Yeah.
I think my intel tells me it's shifting at other places as well, but I think in a lot of ways Goldman leads the way. So congratulations on that.
So the thing is, all the decisions these days are completely data driven. Like trading no longer is about people typing in orders and by looking on the screen. So there are a lot of people that are building these quantitative models that are completely data driven. So definitely a shift. One more thing, because you all are machine learning folks, you really need one of the things machine learning. When I used to do computer vision across the street, was that you need a lot of data, right? You need training data. Guess what? In trading, in our companies, you know exactly which trade you want to put in, which trade or not. You also know the data that preceded them. So you can actually do a lot of machine learning. And I think that's something you should take away, because that's where the trends go. People are building these models using the data. You clearly know whether there was a trade that you made money or not, and you can easily mimic those things. And you can easily use those things for as your trade. All right, with that, I'll stop. Thank you so much for your time.
Thanks so much. Thanks so much, Howard, and Goldman Sachs. I have to say, you all are the first guests I've ever had that finished on time. So I want to give a special round of applause. We may have some other visitors later in the semester. It's great to be able to have people who are, these people are really using computer science for real finance and making a difference in the world. And another thing I wanted to add, Howard is originally a theory guy. And it's important to note that finance and hedge funds are, I think, maybe one of the only enterprises that uses every possible form of computer science. I mean, it ranges from networking. Well, we saw this show the other day, right? How do they use networking? Well, they had a fiber optic link from Chicago to New York, right? You know, how did they decide they needed that? Well, you know, the network experts told them about that. But theory in terms of, at least in one sense, designing optimal algorithms, data science, machine learning, just every aspect of computer science is necessary. Okay, so I need to, as you know, we have a, let's see if I can turn this on to the right thing. We've got a midterm coming up a week from today, so I want to cover a few things about that. And for some reason, the red screen isn't coming up. And like I said, so I'll finish by 2:45, and then I'll hand it back over to these folks. Sometimes there's an event that happens in here after the class. Sometimes there's not. If there's not, you're welcome to sort of hang out in this room, but if somebody's coming in, you might have to step outside. So the first and most important question is what topics will be covered, and the way to tell that is it's all topics before this exam. So that means, in fact, there's going to be 2 lessons that I'm not going to be able to present to you in class before the exam. And they're available on videotape at Udacity. There are also 2 chapters in the book. It's a total of between 30 and 40 minutes of videos to watch. I will additionally cover them in person after the exam, but I'm sorry, you, in exchange for meeting real people doing real finance, you're going to have to watch some videos outside of class. I hope you think that was worthwhile. Okay, so that's, I'm sorry, but anyways, the answer to the question, all of these lessons, excluding 9 and 10, so everything up to efficient markets hypothesis. Okay, any questions about topics on the midterm? Okay, one thing that Maria mentioned that I had actually skipped over in a recent lecture, and I actually want to go back for a moment and address it. She talked about risk exposure, and that actually is related to, if you remember the last lecture, we talked about the capital assets pricing model, and here we go. So let's go back a little bit. So this equation here essentially summarizes the capital assets pricing model for a portfolio. It says that the expected return for your portfolio is related to market return right? R sub m times the beta of the portfolio, right? Plus the sum of the individual alphas, okay? So this is an important equation to memorize and be prepared to answer questions about. Any questions about that equation? And remember that the beta for the portfolio is simply the weighted sum of the betas of the individual assets. Okay, now, this model, the capital assets pricing model, had been around for a few years, and I'm sorry, I don't remember the name of the researchers, but someone suggested, hey, why don't we think about beta, instead of it being just relationship to the overall market, as it being a relationship to different factors. So for instance, airline companies depend significantly on the price of oil. Maybe we should consider a pricing model that considers their quote exposure to energy. Companies that manufacture things like car companies depend on the price of metals and commodities. Why don't we think about their exposure to those assets? And the idea was, instead of having just a single beta, why don't we think about our estimation of the way the price of an individual stock moves as being a beta for each of these different risk factors, or so you don't necessarily need to think of them as risk factors, but just factors that make up. If so, let me ask you this: think about the price of oil. Suppose the price of oil goes up. What do you think happens to the price of Delta Airlines? It goes up. I would think it would go down, because their number one operating expense suddenly, good for you shouting out saying something, but anyways, if their number one operating expense goes up, probably the overall price of the stock is going to go down, because expected revenue is going to go, total profits are going to go down, right? So suppose we had a separate factor here of energy prices. Would the beta of delta to energy prices be positive or negative? Howard? Negative, okay. All right, good. I know I could count out. Anyways, folks have built more complex models that have lots of individual betas instead of just beta to the market. And you can compute these betas in the same way that we compute beta for an individual stock to the market, just with linear regression, except now we have multiple factors, and we can measure those factors each day, and we can compute all these individual betas by finding essentially the equation for the line. So maybe, for instance, that just trying to think of an example of a stock, JP Morgan, for lack of, it may have no exposure to energy prices, but it may have significant exposure to GDP or employment, and each of those can be identified as a separate factor. Now, we start talking about it as a risk factor. What the reason for mentioning that is the extent to which you're exposed to each of these factors means that you might be exposed to a significant downturn or a significant upturn. So delta is exposed to the risk of energy. If energy prices go up significantly, their beta is large, so they have a significant exposure there. Okay, any questions about that? Okay, I wanted to touch on a couple other things. Okay, I left you last time to sort of think about this puzzle, and let me restate it. Let's suppose that using your machine learning, whatever approaches you have, that you have determined that you believe one stock, stock A, is going to outperform the market by 1%, and you believe that stock B is going to underperform the market by 1%. Okay? Now, reasonable people may question, how can you come to believe this? And that's for a separate part of the class. But somehow or another, your intelligence has alerted you to this prediction. Now, furthermore, stock A has a beta of 1 to the market, but stock B has a beta of 2. So in our first scenario, we considered that you put half of your portfolio into A. So you're betting, you're buying stock A, in this case $50. The other half of your portfolio you're using to short stock B. And so we look at the outcome of what happens here, and for the moment assume that our estimates of beta and alpha are correct, okay? So you entered the market here, you entered those positions here, and the market went forward one day and was flat. It didn't go up or down, it closed at the same price. Now your predictions turned out to be correct, so you made 1% on stock A, and because you shorted stock B, you essentially made 1% on stock B. So over here to the left, basically work the math, and half of your portfolio was in A, so you made half a percent of your total portfolio value there. Half was in B, and again you made half there. So altogether, your portfolio made 1% on that day, and the stock, the market was level. Now this next scenario shows the situation where you invested in the same way, but the market went up significantly. The market, indicated here by the blue line, went up 10%. And true to form, stock B went up 20%, but minus 1% that you thought it would underperform. Stock A went up 10% plus the 1% alpha you predicted. And if you add up the numbers, because even though your predictions were right about what alpha was going to do, you lose money because stock B had such a high beta. Okay, so does that make sense to everybody? That you need to care about beta in constructing your portfolio. Now, what can we do about this? Suppose suppose you have accurate models of beta, you have an accurate estimate of alpha for each of the stocks, but the one thing you don't know is what is the market going to do? Now that's a hypothetical situation, but just go with me on it. Again, you have a perfect estimate of alpha for each stock, perfect estimate of beta. What can you do not knowing which way the market's going to go? Just a hint in some direction. Well, okay, let me put it out this way. Should you always put an equal amount into each asset? Okay, great. So in this case, stock B has a higher beta than A. Should you put more of your investment into B or less investment into B?
Less.
Right, okay. All right, we're headed in the right direction. In the end, suppose we want to remove market risk from our portfolio. In other words, whichever way the market goes, we want our portfolio to essentially not be slammed by it, and all else being equal to end up, zero at the end of the day. What should our beta be? 0, right, okay. So what we're trying to do here is select weights on the stocks so that our beta will be 0, but we still preserve alpha, right? Does that make sense? Okay. So here's an example of how we might do that. Oh, I'm sorry. This is an example of the, this is that same 50-50 example where the market goes down 10% and showing that we made a lot more money, but we just had lucky that the market happened to go down. Okay, so anyways, getting back to this original question. Let's see if I can make this bigger. I can't. Okay. Remember, our return is based on the weight that we have in each individual stock, the return of the market, and importantly, this beta that we have. I'm sorry, that's kind of small. So if I can make it bigger. Importantly, the beta for each individual stock. I just do a little bit of algebra here and show that for this particular portfolio, if we're investing half into each asset, our portfolio actually has a negative beta. So that's why we got slammed when the market went up, but we made money when it went down. Still, we have this 1% potential gain from our alphas or the information. Anyways, if we want to make beta 0, it turns out that it's a fairly direct algebra problem. We simply want the beta of our portfolio to be 0, and we just write out the equation of the weights and the betas. Now it turns out that, so in this case, there's a solution where the weight of alpha is 0.66, and I'm sorry, the weight of stock A is 0.66, and the weight of B is negative 0.33. It turns out that you also need to consider the fact that you want the sums of the alphas to be positive. So that's, you want to pick a negative weight for B and a positive weight for A. Now it's fairly direct to compute these weights for this example, but if you have 100 different assets that you're considering, each one with an alpha and each one with a beta, there may be more than one unique solution. And certainly it's not something you would calculate by hand, but you all have actually already been exposed to a tool this semester that can help you solve that, namely an optimizer, right? So what you would want to so let me pose the problem for you, and I'll give you half the answer and see if you can come up with the other half. The constraint that we want to satisfy is that beta is equal to 0, right? Does that make sense? So we want a portfolio that has a overall exposure to the market of 0. But what is it that we want to maximize? Return, or sum of the alphas, right? So you want to find the allocation to each asset that will cause beta to be 0, which means that no matter which way the market goes, you'll be insulated. But you're going to make that money, that alpha, from each individual stock that you separately have estimated returns for. Does that make sense? Okay. All right, let's see how much time. Okay, so we've got a few minutes. All right, so we have, I'm curious, what does Goldman Sachs think about technical analysis? It's good? Okay. All right. Anyways, there are, sorry to put you on the spot.
We use both fundamental and technical.
10 years ago, it would have been sort of, would have been unusual to hear a major banking authority say that technical analysis was a useful source of information. I think things are changing. But what is technical analysis? So a technical analysis is a set of heuristics, for lack of a better term, that you can apply to historical price and volume changes. And they're based on things like, one of the most common is momentum. If the stock for the last 10 days has been going up, a reasonable heuristic is it's probably going to go up tomorrow. So technical analysis would say, let's create some metric that can look at these historical prices and come up with a number that can help us predict whether it's going to go up or down in the future. Now, before I get too much into technical analysis, I want to outline sort of the landscape here of different forms of analysis. The traditional one that you probably have heard a lot about is fundamental analysis. And that's where you look at things like how much cash on hand does the company have, what's the profit margin, in other words, of all their costs, how much above that is profit, what's their revenue, and so on. These are all fundamental factors. And traditionally, those were all the factors that folks focused on when estimating the value of a company. And again, you would look for situations where the stock price is below what you estimate that value is. And if the stock price is below, there's an opportunity to buy and wait for it to come up. Technical analysis is a view where daily price of the stock. This red line is representing a moving average. Now, one hypothesis of among many different technical analysis approaches is that if we smooth out the daily price, for instance, by taking a moving average, that smooth price may be a decent proxy for what we believe the true price of the stock to be, the true value. So if we see significant deviations below this moving average, that might be an opportunity to buy with the expectation that the price would move back up to that moving average. And if we see the current price significantly above the moving average, that might be an opportunity to sell because it's probably going to return back to that moving average. So the general title for these approaches is mean reversion. And it can you can especially see this happen when you can see it a lot when there's significant negative news about a company. So for instance, you certainly remember the Equifax example. In fact, I'll take a look and see if it's true for Equifax, but in a moment before that, let me tell you about one that I know matches to what I'm talking about. You might remember a few years ago, Toyota had a big problem with their trucks accelerating out of control. And there was a recall because of the mats or accelerator pedals. Their stock price took a huge hit, but it went down. But over the next few days to weeks, it recovered. And the central thesis of these sort of heuristics is that the market, consisting of individual people, tends to overreact, and then we see this mean reversion. Now let's see what happened to Equifax. I'm kind of curious. Does anybody know the symbol for Equifax? What is it?
Yeah, EFX.
Okay, you guys are already ahead of me now. Okay, I would say this might confirm what I'm thinking. So we see slam in price due to overreaction and perhaps recovery returning to the mean. A big question is, how do you know when the excursion has kind of reached a stopping point and maybe it's time to get back into the stock? Curious what the Goldman people think. Would you buy Equifax now? Howard?
I would.
You would? Okay, all right, okay. Well, we'll check in a month and see. We'll have the Howard hypothesis and the Tucker hypothesis.
I'm
Okay.
not authorizing investors.
All right, that's a good one. Me neither. So, okay. Okay, but let's get back to Bollinger's idea. So this was an initial sort of technical factor to look for situations where the price was above the moving average as a selling opportunity and below it as a buying opportunity. But the question was how far, how much does it have to move? You shouldn't, because prices can have lots of different overall price points, it shouldn't just be like the number of dollars, it clearly should be some sort of ratio. But furthermore, we have stocks that are, by their very nature, volatile. So let's suppose you try to rule, whenever I see the stock 5% above the moving average, that's a sell, and if I see it 5% below, that's a buy. Well, if it's a very volatile stock, that might be a volatile indicator. So how can you smooth that out a little bit? And Bollinger's idea was simply, in addition to calculating this moving average, the red line, let's calculate a Bollinger band, an upper and a lower, which is 2 standard deviations above and below the moving average. So his idea is that you look for excursions more than 2 standard deviations above or below the moving average, and that's a mark of significance. When you see the stock going out above the upper band, that's a potential alert that it's a huge excursion, and you should see it coming back towards the mean soon. So the Bollinger bands suggest. So here's the overall strategy that people typically use when they use Bollinger bands. Is step 1 is you look for an excursion outside either the upper band or the lower band. So that has to be satisfied. Step 2 is you want up front here. Yeah. We need to connect you with a TA for now. So yeah, hi. Okay, next survey.
September 2, and I think the
No, only for students who were beneficiaries. Well, it wasn't open until after
it's open September 5.
So I don't know what you're saying. I should have submitted to the assistant, unless you had an exception.
Yeah, when I thought that the due for this migration project is in September 22, in the extension session. We saw that, and we saw the inter-project between the two projects should be the monthly rate. So when I go to the display to check, I saw that I tried the assessment, that it's possible. And I saw the extension, I saw that this works for everyone. So I completed my project.
It's okay as long as you submitted it before the deadline.
Although I not
I mean, why would you think you could submit it after this?
I think that in this sense, you have given the organization things now. I still think you post
Anytime there's a deadline, it's announced. Sorry.